In this analysis, we have selected 4 stocks for you that have dropped about 30 to 50%, but all have long-term growth potential. In the short term, the market is a voting machine. In the long term, it's a weighing machine. In other words, the money always goes to the higher quality companies that grow in the long term, but in the short term, you can profit from the fickle Mr. Market. Remember, have your strategy in place for simple investing. Investing with confidence leads to financial freedom. Let's take a look at these declining stocks with growth potential. The amazing company that has recently dropped by about 50% is D2Desk with the ticker PTD. You might wonder, why has the company dropped by 50%? Has it reported a loss? No. Also, expectations were a little lower than expected, but revenue growth was still about 20% plus. So what's going on, you might ask? Simply put, because valuations are relatively high and short-term expectations are not being met, this leads to a kind of irrational price drop. A 50% drop is certainly significant to see your company halved in, what is it, 2 weeks or 2 months. But of course, long-term investing looks at long-term potential. And yes, the valuation is high. It's quite difficult to estimate how much this company is really worth. So that's why we need to closely examine what the management is doing, what the company is doing, and what the long-term growth looks like. Now, in the notes on D2Desk, they provide a kind of omni-channel marketing and offer multiple channels for that. But why D2Desk is very interesting for the long term is because they mainly focus on connected TV, meaning personalized ads via television, but also, for example, billboards, what they do audio and video. Moreover, I had a very large position in the plumbing. After more than 1,000% return, I sold off a significant portion of that. And the plumbing isn't really a competitor to those 2 desks because the plumbing is much more focused on mobile apps. No, the name says it all. And that D2Desk is definitely a different ball game. Okay, in the long term, the 2 will have to compete with each other. That's a point to consider. But still, if you look at the numbers from D2Desk, which has been mismanaged since 2013, what we see is nothing but impressive revenue growth year after year. Very interesting. And of course, that revenue growth will decrease over time. But if they can maintain that 20% plus for the coming years, that's really interesting. And not only that, they have been screaming since 2013, and profitability is only increasing. So you have revenue growth and profit growth, and you don't see this combination very often. Primarily, what's more interesting is the CEO, Jeff Green, who is also the founder since 2009. Well, you'll need to dive into this yourself. This man has a very good perspective on the market. He has made a lot of good predictions, all of which have come true. Really very impressive. I also believe that D2Desk has consistently been priced better than expected for the past 33 quarters, and this was actually the very first quarter in which they priced lower than expected. Why might the shock be so great? Because it's the first time in a long while. If you look at the long-term growth, it's just bizarre. And the current drop in price means that the price level is back to 2020. Back then, the company was not as strong, I can tell you. But you'll see that here too, short-term volatility has led to lower price levels. I've set an alert for myself at a price level of 62. Hopefully it will drop to 62. Then I find it very interesting to calculate, well, whether this is a good potential investment compared to the current holdings in my portfolio. So it's obviously about opportunity costs. But if you're talking about a quality company with strong management, then D2Desk is definitely an opportunity you want to look into further. Well, that current valuation seems really high, a price to earnings ratio of 95 and 84. According to this model, a bad luck ratio of 1.6, which isn't great either. On the other hand, the price to cash flow is also relatively high. A price to sales ratio of 14 isn't exactly cheap. So many metrics suggest that the company is indeed valued on the higher side. And that's, of course, the risk with this company. A high valuation in the short term, because it has a lot of long-term potential. So that's why you see these kinds of shocks happening. And the question is, of course, how far can the share price drop? Very interesting. Looking at the piece of history and especially the demonstrability of the past, so they indeed achieved 15% organic growth per year, even more than that. Also, if we look at the EBITDA growth, it's really starting to pick up and was always around 30%, which is truly phenomenal. The EPS growth for next year is still estimated to be around a 50% increase. More importantly, for the longer term, in 3 to 5 years, it's at 24%. So very interesting growth figures, and we can only hope that they can continue this growth. The market value is currently around 35 billion. Can it go up tenfold? That's always the question I ask myself. Yes, then it would have to grow to about 350 billion. On the other hand, Abloving has done that also in 4 months' time, 14 months' time. I don't know if D2 Desk is going to do the same, but you can definitely see the long-term growth potential, which can be very interesting. Whether it will go up tenfold in the long term, no idea, but it definitely has the potential to at least bubble up or more. Net profit margin is increasing. As mentioned, it's not just about revenue growth, but also profit growth. Return on equity is starting to climb more and more. I think they can definitely exceed 20% in the long run. The business model is really good, but they are still investing a lot in research and things like that. For that, you can also take a look at the balance sheet yourself. Well, their current multiple was very high, and according to this model, it has now dropped to a bit lower, 44. This one seems to be correct, by the way. The other one indicated a bit higher. The important thing here is to look at what exactly the value is. However, for those two tasks, this model won't work well because you can see that those high multiples are way out of range for what is normally expected from different types of companies, where the EPS growth in this model is also estimated at around 20%. So you would actually need to maintain a multiple of 18 because the EPS growth in 2015 is the only outlier that is lower than expected. Normally, you would say that a price earnings of 25 is healthy, but with the current development, you could still develop a negative return. So here is basically the assumption of whether the market will continue to pay a higher multiple for a longer time, and if the company can keep outperforming and delivering strong results. Yeah, so this is really tricky. So in this model, you can't say too much about it. You're looking at the long term, and they can achieve an EPS growth of 20% up to 2030. First of all, that's already a long time. A second EPS growth of 20% per year on average is still very high. But okay, let's assume, theoretically speaking, that it is possible. Then you would want to pay a multiple of 21. But maybe because 2Desk is a phenomenal company, you might want to use a higher multiple. Let's really assume 21 means an average element from this current price level of about 8% if you assume a multiple of, say, 15, which is on the lower side, provided that those 2 decibels still have the strong competitive advantage, a strong market position, then you have almost no return. Is it higher, for example, because the market is euphoric again, or because they achieve exceptional results in the short term, but only in the year up to 2030? So that's obviously looking into a crystal ball, and nobody has a crystal ball. Then the average return would be higher, around 14%. So this is always a downside with high quality companies that have high valuations. Short-term shocks can be huge. And actually, you should hope that this price drop continues a lot further so that it becomes easier to say, well, this seems like a really good investment. And it's easier. Why? Because then the current valuation drops, which increases the likelihood that it will remain valuable in the long run. It's actually that simple. So uncertainty also brings more productivity. That's the lesson we see here with that second desk. So always be careful with good companies that have a lot of potential, because if they have a high valuation, then it can easily go the other way based on quarterly results. Looking at parallel industries, it has dropped by about 50% from its peak, 51% actually. I actually got in recently after following it for quite a long time, but maybe I expected it for too long, who knows. I had gotten in somewhere in the second week of January, but since then it has dropped by 30%. And the question, of course, is how far can it drop? Maybe it finds a technical support level around this price level here of 162 or even 150. But that's all based on a few charts. And as long-term investors, we obviously look at the fundamentals. Now, because of this huge price drop, let's say the price to earnings ratio has become relatively cheaper. Namely, for next year, it is estimated that the price to earnings ratio will drop to around 12.6. And the withdrawal ratio is just above 1. Ideally, we want it to be below 1 due to the long-term growth, of course. But hey, 1.1 isn't super bad for a company that potentially has very long-term growth potential. Looking at the price to cash flow, we actually see a different story. It is relatively higher. And the price to sales ratio is relatively a bit higher, but a price to sales of 2 doesn't seem extremely high to me. Keep in mind this company is still very small with a market value of 2 billion, hardly any debt, and a healthy cash position. The good numbers look impressive. And what we want to look at, for example, are the EPS growth expectations for the coming years, which are estimated at around 11%. Well, that seems realistic to me, and it's also in line with 5-year averages. But Paul Industries might even continue to surprise because of the whole trend of, yes, artificial intelligence and the need for data centers, but also the entire industry obviously needs electricity. EBIT growth is estimated at around 50% for next year, which is quite a significant increase. Looking at the profitability part, well, the current net margin is significantly higher than the 5-year average. There's also potential risk here that the profit margins might drop back to, for example, the historical average of this company. 15%, we see the earnings model is also on the high side. 10% might be better, but time will tell. Return on equity is very high, and return on capital is also very high. So it's not just any reason that the company has risen a lot in a very short time, because before this price dropped by 50%, it had actually risen by about 300% since 2022. So that's obviously a huge price increase. Looking at the valuation part, we see that the current price has fallen below the fair value line. In other words, the company may be undervalued. And it sounds good too. Let's look at some forecasting based on EPS estimates. There aren't many analysts, but if we assume an average of about 10%, which aligns with other sources, then that seems realistic. So, the price to earnings ratio has dropped quite a bit, down to 13, compared to around 27 at its peak. Well, the current price to earnings ratio is around 13, and for next year it's set at about 12.6. And if we assume a price to earnings ratio of 15, since that's somewhat average, it could yield a potential return of 20% per year. So the outlook seems better than, for example, the S&P 500, which has a much higher valuation. I don't want to say that the price can drop further. You never know in the short term. In the long term, there seems to be more certainty about the returns. We think positively. We also look closely at management, and we aim to run the company well and independently. Please think critically. Looking at the EPS growth, the estimate given here is 14%. That seems a bit high to me. I would actually expect a lower EPS growth, for example, around 8%. So what you can do better here is to create a discounted cash flow analysis to calculate the intrinsic value. But if we go with this model, since that 40% is on the high side, we'll take a lower multiple in this case. If that multiple ends up at 12, it could provide an average return of about 13%. And that seems like a realistic assumption to me. In the very long term, you obviously don't know what's going to happen. But from current price levels, it seems that there is more upside potential than risk. So Paul Industries is indeed an interesting stock, down about 50% from the last Altium high. I don't want to say that it can't drop further, as it might in the short term, but the current valuation seems to present a good dip opportunity for long-term investors. Somewhat similar to Paul Industries is Burt Constructions with the drawing BDT. This is a very interesting company. Still a relatively small company, and it certainly has the potential to grow in the long term. In the short term, however, it has dropped by about 32%. Could it find a support level here at the price level of around 21? That might seem possible, and the fundamentals look really good, but the long-term potential is also very important. Keep in mind, technical analysis is just a simple tool, and it should really be the last resort when deciding whether to buy a stock or not. Of course, the choice should be 95% based on whether it's a strong company or not. There are a number of interesting characteristics about Bird Constructions. By the way, I came across this stock or this company because someone commented on YouTube saying, "Hey, I also have a position in Bird Constructions. Take a look at it." Very interesting. And thank you for the tip. The person probably knows who it is. Now, the company is a construction firm with 100 years of experience, a number of interesting things. First of all, they are currently benefiting from what other data centers are experiencing, an increase in orders. But as you can see, they have also recently published new contracts, such as mining company contracts. And if you look at what they do, I also find it very interesting that they make an acquisition almost every year, a strategic acquisition. The last one is BK Pros Construction, and you can check everything out on their website. The recent financial highlights also look very promising. Nevertheless, the price has dropped by 30%, probably a short-term correction, because it might start to rise in the long term. But be somewhat cautious with construction companies. They are always the first to be hit when tougher economic times come. So the revenue has increased significantly, and the backlog is of course very important, and it also seems to be growing, so that's really good. but the question is how many contracts they will actually secure. EPS has risen significantly, and the EBITDA margin is also increasing a bit. Even more interesting, perhaps for long-term investors, is to look at the management. Now, what's really interesting is that the key positions are all held by people with a lot of experience within the company. Not only that, but they have also been active in the company for many years. So the CEO has been active since 2017, the CFO has been active since 2016, and the Chief Operating Officer has been with the company since, if I'm correct, 1991 after an internship. So very interesting. He has, of course, been with the company for a long time, and so are the other roles, actually. Yeah. Quite experienced people, but especially a lot of experience within the company. It can also have downsides, but in my opinion, there are more advantages because it gives a sort of founder mentality. Let's take a look at the fundamental prospects of this company. First of all, after this significant price drop of 30%, the stock seems to have become relatively cheap again, with a price earnings ratio of 12.7 and estimated at 11.3 for next year. The failure rate for non-GAAP is not known, and the failure rate on GAAP is 0.3. Other things look quite good. The price to cash flow for next year is estimated to be around 6.6. They also pay out dividends, although I wouldn't do it for that. The market cap is still relatively small. Personally, I find that very interesting. I prefer to invest in relatively smaller companies because they can simply grow more easily. In the long term, to 5 times, 10 times, or even 20 times. But of course, smaller companies also have a higher chance of failing, fewer economies of scale, often a weaker competitive advantage, that sort of thing. So uncertainty is increasing. Long-term debts have increased a bit, and the class position in the short term at least provides some solvency in the short term. Sales growth has increased significantly, as we saw at the beginning of the video. For next year, it's still estimated to be around 80% growth, and also the EPS, which is what it's all about, is projected to show strong growth. Profitability is still relatively low at the moment, so I think this is an advantage in itself, because you can argue that if return on equity increases further and return on vested capital and the profit margin increases, that will of course give an even lower multiple. So at Powell Industries, we saw that the net margin is very high relative to the historical profit margin of this company. And at Bird Construction, we don't really see that yet. So it could also be the case here that profitability will increase, but that's more of an assumption than a conclusion. So that's something you want to include further in your analysis. Now let's take a look at some fundamentals of this company based on the current valuation. Then we're going to set up a few screeners for Bird Construction, as well as for Powerwall Industries, which we just discussed. You can see on a historical scale that the price-earnings ratio seems to be below the intrinsic value, as the intrinsic value in this case is represented by the price-earnings ratio of 15, or the orange line. This also seems to be the case in the short term. Let's take a look at some forecasting. A number of analysts, about 7, have dared to provide an EPS estimate, and based on that, you could maintain a price-earnings ratio of 25, given the strong EPS growth expectations. Well, the current price-earnings ratio is relatively low, especially after that recent drop. Let's be more cautious and take a price-earnings ratio of 15. However, this is based on the crucial condition that the EPS estimates below are accurate, because in the long term, the stock price more or less follows the earnings per share. Actually, even better, it follows a sort of discounted cash flow, or actually an increase in free cash flow, but the EPS is often taken as a sort of shortcut. Well, you can see that the potential return is still very high, with a price to earnings ratio of 15, namely about 40% upside potential on average per year, which means a total potential return of around 200%. That's obviously a lot. If it were to grow to a price to earnings ratio of 25, then the average return would even exceed 70%. By the way, I wouldn't assume that myself. However, you can see that there is upside potential for this company, and I'm also very interested or curious about the annual acquisitions, how valuable these acquisitions are. The long-term cost of capital is set very high at 41%, so we're not even going to attempt to see what the potential return is because I don't believe that's accurate. Moreover, the construction sector, no matter how strong the company is, always has cyclical movements. So this will go with ups and downs. All in all, Bird Construction seems to have a potential support level around 21 from this current price level. Yes, it does seem like an interesting entry point. We never know what the market is going to do what it does in the short term, but in the long term, it could grow, especially because, for example, the management seems to have a sort of founder mentality. It's not really a family business, but you get what I mean. So it has all sorts of green check marks for long-term potential. Finally, the last company that has recently seen a significant drop in value is United Rentals. The stock has dropped by almost 30% compared to last week, and you can see a clear downward trend is underway. United Rentals is a serial acquirer. At least that's how it started. It has simply acquired various smaller companies and continues to do so, thereby creating a huge platform company with all sorts of synergy benefits. Think of things like forklifts, but also work platforms that they simply rent out. Interesting business model. They've realized it well for the long term. In the short term, it has indeed dropped quite a bit. If we look at a possible support level in the short term, it could be around this price level of about 600 to 613. I'm very curious about what happens when it reaches that level. And this support level seems very realistic, of course, because we're looking at it based on fundamental valuation. And actually, you should only draw conclusions in combination with fundamental valuation. And of course, we are long-term investors. Looking at that, at those fundamental valuations, we see that the price to earnings ratio for next year is estimated to be around 15. Well, that doesn't seem too high for this company. The market value is, by the way, 40 billion. So there is still some growth potential. Keep in mind, they do have quite a bit of debt. Those debts are also related to the strategy they employ with many acquisitions and such. Of course, the equipment they have is quite capital intensive. So pay close attention to that. Other things seem a bit more positive as well, like the price to cash flow, but for example, the price to sales ratio is a bit on the higher side, at least compared to the sector median. Well, the revenue growth seems to be slowing down a bit, but keep in mind that there is still some potential here, not just for organic growth, but also for additional growth due to acquisitions. It could also be a very large acquisition, but of course, the question is how management feels about that. The EPS growth expectations are around 11%. Looking at the profit margins, they are excellent, even increased compared to the annual average. And this is very important for a serial acquirer company, but for any type of company, return on equity, right now it's very high, but the 5-year average is still very high as well. Return on capital is around 10%, so ideally we would like to see it a bit higher, around 15% for true long-term. Looking at the historical valuation, we see that the price has now fallen below the possible intrinsic value after this significant drop of about 30%. We're also zooming in on the short term. What does that mean? Well, that intrinsic value expressed in price to earnings is 15 within this model. That's, of course, something different from the discounted cash flow methodology. You understand that yourself. That price to earnings ratio has dropped to about 14.5 in this model, and we see the EPS estimates from analysts. Well, there are quite a few, so let's assume that these EPS estimates are somewhat accurate because they aren't overly high either. So a price to earnings ratio of 15 seems realistic, which gives you a potential of 11% per year. Looking at the normal multiple, it has been a bit lower in recent years, namely 12.4, and then we see that the potential return from this price level is only about 4% on average. So that's a bit less attractive. So here the question is, hey, maybe it can drop even further. But that's really just a question of how far, and that would mean a serious price drop of about 50% if it falls to this level here. 54. Almost more than 40% slowdown. So all in all, it still seems quite interesting. It could get even more interesting if the price drops further, but yeah, I have no idea what the market will do in the short term. No one has a crystal ball, not me either, so we have to wait and see what happens. In the long term, the EPS growth estimate is about 12% on average per year. Yes, I prefer to assume something a bit lower myself, but given the model, that model could be correct. What does that mean? Well, if we then assume a normal multiple of 12 from this price level, it could achieve an average return of almost 10%. And that's, of course, the compounding effect. With a higher multiple, for example, if we perform really well, that could rise to about 13.6%, so United Rentals, regardless of the long-term growth they have already achieved, could still be the most interesting investment for long-term investors. And the recent drop in price might offer an interesting initial entry point. Because you're not sure what the market will do, it might drop further. And that would be a good strategy to buy more. In other words, dollar cost averaging. and you do that for your entire portfolio, filled with quality companies for the long term. That's it. Thank you for watching, and I would say subscribe. That would be appreciated, and see you next time.